Hello folks, and welcome to my discussion for Accounting 1120, where I continue discussing corporations. As you'll recall, I call this the land of 10,000 tiny topics, so let's tackle another one. In this pencast, I would like to learn the accounting techniques for Treasury stock transactions. Before we get too far, let's talk about some details of Treasury stock. First of all, what is Treasury stock? Treasury stock is stock that you purchase of your own corporation. It's stock you have issued in the past, and you're buying it back in the open market now. Why would you buy your own stock in the open marketplace? Why would you buy your own stock? Well, first of all, maybe you're trying to support the market price of your stock by providing a place for someone to sell it. Maybe you're going to buy your own stock while the price is low and sell it when it's high. Make a little bit of money on it. Maybe you're trying to prevent someone else from buying it in a hostile takeover attempt. Or maybe you're going to offer it to employees as an employee stock option plan, an ESOP. There are lots of reasons why you might want to buy your own stock in the open market. Where does the account Treasury stock live on the balance sheet? So Treasury stock is an account. It is part of stockholders' equity. It's a contra account, meaning it has a debit balance. And it lives right under retained earnings. So on your balance sheet, you'll see stockholders' equity, this section, and you'll have your paid-in capital, then you'll have your retained earnings, and right under that, you'll have Treasury stock. It will be having a debit balance, so it will be a contra account. As we go through the accounting for Treasury stock, please note that no gains and losses ever come about from Treasury stock transactions. They will never affect the income statement. So, let's look at some Treasury stock transactions, shall we? Let's start with some facts. Let's assume first that you buy 1,000 shares of your own stock in the open marketplace, and you do this by paying $20 a share. You will debit Treasury stock for $20 times 1,000, or 20,000, and credit cash for 20,000. Now that you have purchased Treasury stock for $20 a share, watch and see how under the cost method of accounting for Treasury stock, that kind of acts kind of like par value. Let's move on to another transaction. Let's say you sell 300 of those shares that you bought for $22 each. How much cash will you get? 300 shares, $22 a share, you will get $6,600. How much comes out of Treasury stock? Well, you put it in Treasury stock at $20 a share, so it must come out at $20 a share. 300 times 20 is 6,000. So you sold it for $6,600, and you paid $6,000 for it. The credit will be to paid-in capital from Treasury stock transactions, a new account in the amount of $600. You've kind of had a gain on the sale of Treasury stock of $600, but remember, we can't affect the income statement with sales of our own stock with ourselves. It's not an arm's length transaction, so rather than call it a gain on the income statement, we'll create a new layer of paid-in capital, and it will be called paid-in capital from Treasury stock transactions. That's an important piece of it. Now, let's sell some more. going to write a little tinier here so I can get it all in. This time we're going to sell 300 shares for $15 each. Kind of a loss on it. We bought it for $20 and we're selling it for $15. First of all, how much cash do you get? Well, there'll be cash of 300 times $15 each. 300 times 15 is $4,500. We need to then take out the treasury stock, and I'm going to come down a couple of lines here and write treasury stock and work a little bit backwards. It went in at $20 a share, so it has to come out. So 300 times 20 is, it has to come out at $6,000 a share. So you can see we've had a loss, so to speak, of $1,500 on the sale of treasury stock. The first thing we need to do is to eliminate any paid-in capital from treasury stock transactions that exist in the past. We have $600 in that category, so we'll get rid of that first. We'll reduce that account down to 0, but no more. And you'll notice that that's still not enough to handle the loss that we had on this treasury stock. So the difference will come out of retained earnings. If you think about it, we would have had a loss, and we would have called it a loss. We would have put it on the income statement as a loss, and it would have been taken out of retained earnings. But because it's a transaction in treasury stock, we can't have a real loss. So we'll go directly to retained earnings and skip the income statement. Now our journal entry balances. We pick up the cash. We eliminate our paid-in capital to the degree it exists. We take to retained earnings any deficit, $900 in this case, and that makes the journal entry balance at $6,000. You can see in this way that I haven't had any gains or losses hit the income statement. When I sold treasury stock at a gain, I didn't call it a gain. I went to paid-in capital treasury stock transactions. It's like a gain, but we can't call it that. And when I had a loss, it went directly to retained earnings because I can't have a loss on treasury stock transactions. Let's explore the idea now of how we report treasury stock on the balance sheet. Well, you know, we have assets and liabilities and stockholders' equity, and obviously I'm talking about stockholders' equity. Under stockholders' equity, we have paid-in capital, where we list all of the money we receive from owners. We have retained earnings. I'm abbreviating a little. Retained earnings, where we put all the money where we've had net income closed into the business. I guess I should write that out, huh? Let's do retained earnings. Well, that was handy. I could use that E. And underneath that, we have an account called treasury stock if we have some. And it's got a contra account, and it's underneath retained earnings on the balance sheet. Recall, under paid-in capital, we'll list common stock. We'll list the par value of it. Maybe our stock's $10. That's always shown. This is kind of sloppy, but it says authorized. Let's say we have 100,000 shares authorized. We would always show that on the balance sheet. I'm not using numbers now, just amounts. So we'd say we have authorized 100,000 shares. And in our example, let's say we've issued 50,000 in the past. And now we have some that's outstanding. If you'll recall, we had 1,000 shares of treasury stock that we bought, and then we sold 600. So the difference is 400. So we have issued 50,000, but now 49,600 is outstanding, and 400 shares are in the Treasury because we had 1,000 shares, but we reissued it. So I've done our stockholders' equity section and shares of stock instead of dollar amounts. We had 100,000 shares authorized. Let's pretend we've issued 50,000. Since we still have 400 in Treasury stock, there's a difference between issued and outstanding, the amount of Treasury stock. Now that we've explained how it looks per share, let's put some dollar amounts to this in our imaginary situation. If we have paid in capital, the first thing in it would be common stock. It would say on the face of the balance sheet, par value 10,000, 100,000 shares have been authorized, 50,000 have issued, 49,600 of which were outstanding. That means that in our paid in capital account, we have 500,000 because you have 50,000 times $10 a share, 500,000. We didn't really say how much our stock was issued for in our example, but let's say we have some paid in capital from common stock. We issued it for more than par value. I'm just making this up. So we have another 100,000 there. So our total paid in capital in my example is 600,000. 550,000 times $10 par value plus another 100,000 from when we issued it. Then let's further pretend we have some retained earnings. Let's say our retained earnings was or is 600,000, excuse me, 800,000. So we had retained earnings of 800,000, and that's after we've taken out any from our Treasury stock transactions. And so we have our paid in capital of 600,000, retained earnings of 800,000. Can't look this up anywhere because we're just making it up. And then underneath that would come Treasury stock. And in our example that we had 400 shares left outstanding, and the shares were $20 a share. So there would be $8,000 of Treasury stock, and it would have a contrabalance. Remember, we had 1,000 shares, and then we sold 300, and then we sold 300 more. So that's where I'm getting 400 left. And it was at $20 a share. So it would have 8,000. Our total stockholders' equity in this example, total stockholders' equity would be 1,392,000. Some from paid in capital, some retained earnings, and then a reduction for the amount of Treasury stock at the bottom. Let's summarize. First, the difference between what we show on the balance sheet as issued and outstanding is Treasury stock. You show 50,000 issued and 49,600 outstanding. The difference is Treasury stock. That's one thing to note. Another thing to note is if it's sold and we make money on it, it adds a layer called paid in capital from Treasury stock transactions. Third thing to note is it's a contra stockholders' equity account. It has a debit balance. And the last thing to note is we'll never have a gain or a loss. If we have a gain, it creates paid in capital Treasury stock transactions. If we have a loss, it wipes out paid in capital from Treasury stock transactions. And if there's a bigger loss than that, it goes directly to retained earnings. So it never hits the income statement. I think I spelled earnings wrong. Oh well. Hey, thanks for joining me. Talk to you soon. Bye now.